All right, let's dive in. Today, we're taking on a question that might seem simple on the surface, but it gets pretty complex the deeper you go.
Yeah, definitely.
Currency values, why are they different all over the world?
Exactly. That's the one.
So we've got a video here. The title's Why Different Currencies Have Different Values. Makes you wonder, right?
Yeah, for sure.
Like, why isn't one US dollar the same as one euro or even one Vietnamese dong?
Right. It's a question that's probably crossed everyone's mind at some point when they're, dealing with money.
Absolutely.
Yeah.
And to really unravel this mystery, I think we need to kind of go back in time, like way back.
Yeah. Back to the good old days when money was actually tied to gold, the gold
Ah,
standard.
the gold standard. I remember vaguely, like from history class, but honestly never really got how it all worked.
Yeah, well, imagine a world where every dollar, every pound, every franc you had was actually backed by a real piece of gold that the government kept safe somewhere.
So every time you know someone say like, oh, that's as good as gold, they literally meant you could trade your paper money in for the real deal.
Exactly. It was all about stability. Like in the US, they used to have this fixed rate where 1 ounce of gold was always worth $35,
Wow.
which meant that exchange rates, between countries were pretty predictable. Everything was tied to this gold thing.
Okay, that makes sense, but I'm guessing it didn't last forever, did it?
You got it.
Yeah.
As economies got bigger, more complex, global trade exploded, that gold standard started showing its cracks.
Yeah, trying to manage the whole world's money with just like a limited amount of gold doesn't sound very practical.
Not really. And especially during like wars or economic crises, countries often struggled to keep enough gold to back all that paper money.
Okay, so what happened? Did we just give up on tying money to something real?
Pretty much.
Uh,
By the 1970s, most of the world had moved to what we call fiat money.
Fiat money.
Yeah, and fiat money isn't backed by gold, oil, or anything like that. Its value comes from, well, government decree. They say it's worth something, and more importantly, people believe it. Public trust.
Wow, so it's like our money is valuable because we all agree it is. That's kind of wild.
It is kind of mind-blowing when you stop and think about it, right?
Definitely. But with fiat money, if it's not tied to anything tangible, how's the value determined?
It's all about supply and demand, just like any other product out there. Like if lots of people want something, the price goes up, and vice versa.
Okay, so it's like a constant auction going on with everyone's currencies being bid up or down depending on how much other people want them.
You got it. Think about it.
Yeah.
Strong economies, the ones with high demand for their products and services, they usually have stronger currencies.
Yeah, because people need that currency to buy those things, right?
Exactly. Take the US dollar, for example.
Uh-huh.
It's seen as a safe bet, stable economy,
Yeah, so people all over the world want dollars, which means there's always demand.
which keeps the value relatively stable, yeah. But when economies aren't doing so well, that's when things can get a bit messy.
So what happens to their currencies?
Let's look at Zimbabwe back in the early 2000s. Hyperinflation, prices going through the roof. Crazy stuff.
I vaguely remember hearing about that.
Yeah, their dollar just plummeted. At one point, you needed like 600,000 Zimbabwean dollars just to get 1 US dollar.
Hmm.
People just lost all faith in it.
Wow. It basically became worthless.
Yeah, they eventually had to start using other countries' currencies like the US dollar and the South African rand just to get by.
That's a pretty extreme example of how much economic trouble can impact a currency, huh?
Definitely. But okay, so if it's not gold backing our money anymore, what are the big factors that make these values go up and down? What makes one currency stronger than another in this whole fiat money world?
Yeah, what drives that supply and demand you were talking about?
Well, there are a bunch of factors that play into it. Inflation is a big one.
Okay, inflation. I hear that word everywhere, but honestly, could you break it down for us? What does it mean, and how does it mess with the currency's value?
Imagine this. You go to the store today, loaf of bread costs, say, $3.
Okay.
Next year, same loaf, same store, it's $3.50. That's inflation in action.
So your money doesn't buy as much as it used to.
Exactly. And when that happens a lot, people start losing purchasing power. Their money's worth less.
Ah, so basically, if I'm holding onto a bunch of cash in a country with high inflation, my savings are kind of shrinking every day.
Yeah, basically.
That-
And that makes people nervous, so they look for other ways to protect their money, maybe invest in real estate, or even try to convert their money to a more stable currency.
So inflation makes a currency less attractive, which means less demand, and that drives the value down.
You got it.
Okay, makes sense. So besides inflation, what else is at play in this whole currency game?
Well, interest rates are another major player.
Interest rates, those are set by central banks, right? What do they have to do with currencies?
More than you might think. See, when a country offers higher interest rates on investments, it's like a magnet for foreign investors looking for better returns.
So it's like an incentive to put your money in that particular country because you could earn more.
Exactly. It's all about potential profits. To get a better picture, let's look at government bonds. Basically, you lend the government money and they promise to pay you back with interest.
Okay.
Now, when a country offers higher interest rates on these bonds, it's more appealing to foreign investors. But to invest, they got to buy that country's currency first.
Ah, I see. So higher interest rates bring in investors who need to buy local currency, which then pushes the value of that currency up. It's like a chain reaction.
Precisely.
But isn't it tricky for central banks to get those rates right? I mean, it can't just be about attracting foreign money, can it?
You're absolutely right. Central banks have a tough job. They need to find that sweet spot, you know, attract investment and boost economic growth, but also keep inflation under control and make sure people can still borrow money without being crushed by interest payments.
Sounds like a delicate balancing act.
It really is. And what these central banks say and do can have a huge impact on markets worldwide, affecting currencies everywhere.
Wow, it's like a high-stakes game with all these moving parts. So we've got inflation and interest rates influencing a country's currency value. What else should we be keeping an eye on in this global currency market?
The big picture stuff, a country's overall situation, like is it politically stable? What about the economy? Is there a lot of uncertainty?
Right, because I imagine a country that's going through a lot of political turmoil or struggling economically wouldn't be very attractive to foreign investors.
Exactly. Investors want predictability. They
Yeah.
want a safe place for their money where they can expect it to grow, stable governments, sound economic policies, a legal system that works. All these things attract more foreign investment.
And more foreign investment means higher demand for the currency. So basically, a country's stability is like a seal of approval that makes investors more confident putting their money there.
Right.
Got it. So we've got inflation, interest rates, and stability. What about a country's trade? Does that play a role in currency values too?
Big time. A country's trade balance, that's the difference between what it exports and imports. That can have a huge impact.
Okay, so if a country is selling a lot of stuff to the rest of the world, that means there's high demand for its currency, right? So it strengthens.
Precisely. Think about it. If a French company wants to buy cars from Germany, they need euros to pay for them.
Hmm.
That creates demand for euros, boosting its value compared to, say, the dollar.
But if a country imports way more than it exports, that means its people are always exchanging their local currency for foreign money to buy those goods, right?
Exactly. So there's more of their local currency floating around out there, which can drive its value down.
Interesting. So basically, a country with a strong export market is going to have a stronger currency because everyone else needs it to buy their stuff. Are there any real-world examples of this playing out?
Oh, tons. One of the most striking examples is what's called the petrodollar.
Petrodollar. That sounds interesting.
It basically refers to the fact that oil, black gold, one of the most important things traded globally, is primarily bought and sold using U.S. dollars.
So even if the U.S. economy isn't doing great, there's still this huge global demand for dollars because of oil.
Exactly. It's a reminder of how intertwined the global economy really is.
Hmm.
What happens in one corner of the world can have a ripple effect on currencies and economies far away.
It's mind-blowing, isn't it? So to sum it up, we've got inflation, interest rates, a country's stability, and its trade balance all playing a part in how currency values are set. It's way more complex than I initially thought.
For sure. But there's one more piece of the puzzle we haven't touched on yet. Countries that peg their currencies to another currency.
Oh, yeah, that's right. What's the deal with that? Why would a country do that, and how does it work?
Pegging is a strategy, particularly popular with smaller economies. Instead of letting their currency just float freely in the market, they link it to a more stable currency, like the U.S. dollar.
So, for example, if a country pegs its currency to the U.S. dollar, their currency goes up or down in value directly with the dollar.
Pretty much. Belize has done this, pegging their dollar to the U.S. dollar at a fixed rate. Brunei does something similar with the Singapore dollar.
So it offers stability, makes trade a bit easier, but it also means they're tied to the fate of that other currency. If the U.S. dollar takes a hit, so does the Belize dollar.
Exactly, it's a trade-off. They gain stability but lose some control over their own monetary policy.
It makes you wonder, though, could we ever just have one global currency for everyone?
Now, that's a question that sparks a lot of debate.
I mean, imagine the convenience, traveling anywhere without worrying about exchanging money.
Sounds pretty utopian, right?
Mm-hmm.
But is it really feasible? Or even desirable?
Yeah. Are there hidden downsides to a single global currency?
Well, let's dive into those complexities next time.
All right. Stay with us, folks. We'll be right back to explore that fascinating question. Okay, so we're back and ready to tackle this whole single global currency idea. It sounds pretty futuristic, doesn't it? Like, no more exchanging money at airports, no more trying to figure out exchange rates, just one currency for the entire world.
Yeah, it definitely has a certain appeal, especially in today's world where everything's so interconnected.
But like most things, I'm guessing it's not as simple as it sounds.
You got it. There are definitely some serious challenges and potential downsides to think about. To really grasp this, let's take a look at the Eurozone, a group of European countries that actually did adopt a single currency, the euro.
Ah, yes, the euro. I remember when that first came out, it seemed like a pretty bold move at the time.
It was, and in many ways, it has been successful. The euro has made trade and travel within those countries a lot easier, but it's also shown some of the inherent issues that come with a shared currency.
Like what kinds of issues?
Well, for starters, having a single currency means having a single monetary policy for all the countries using it. So things like interest rates are set by a central authority, like the European Central Bank, and that might not be the best fit for every country in the group at any given time.
So what happens when different countries within the Eurozone have different economic needs? Like, let's say one country is dealing with high inflation while another is struggling with slow growth.
That's exactly the kind of situation that can create problems. A policy that helps one country might actually hurt another. And that's kind of what happened during the Eurozone crisis back in the early 2010s. Countries like Greece were having some serious economic problems. And because they were using the euro, along with stronger economies like Germany, they didn't have as many options to deal with their specific challenges.
So being tied to a single currency can limit a country's ability to respond to its own unique economic situation.
Exactly. It can lead to some countries benefiting more than others, which creates economic imbalances and can even cause political friction.
So if those are some of the potential downsides of a regional shared currency like the euro, imagine trying to do that on a global scale.
Yeah, that would be incredibly complex to pull off. You'd need a global central bank that has the authority to set monetary policy for the whole world. And then you'd have to somehow balance the incredibly diverse economic needs and priorities of developed and developing countries, democracies, and authoritarian regimes. It's a massive undertaking.
It sounds like it could easily turn into a recipe for chaos, but even setting aside all those logistical nightmares, is having a strong currency always the best thing for every country? Wouldn't some countries actually benefit from having a weaker currency?
That's a great point. And the video you sent in actually touches on that too. A strong currency isn't always the answer, especially for countries that rely heavily on exports.
Because if their currency is too strong, their products become more expensive for buyers in other countries, right? So it makes them less competitive.
Exactly. A weaker currency can actually boost exports and make a country's products more appealing on the global market.
So there's a strategic element to this as well. Governments might even try to manipulate their currency's value to get a leg up in trade.
You got it. It's definitely a controversial tactic, but some countries have been accused of deliberately weakening their currency to make their exports cheaper. And that can cause tension with their trading partners who see it as an unfair advantage.
It sounds like this whole world of currency values is full of these intricate balancing acts and strategic maneuvers. So for those of us who aren't economists, why does all this matter? Why should we care about these things?
Well, understanding how currencies work and what affects their value can help you make better financial decisions, whether you're planning a trip abroad, investing in international markets, or just trying to understand the news. This knowledge can be really valuable.
So for example, if I'm planning a vacation to Europe, knowing how the dollar is doing against the euro could help me decide when to exchange my money or even which countries to visit.
Absolutely. If the dollar is strong, your trip to Europe will be more affordable. If it's weak, you might need to adjust your budget or think about destinations where your money will go further.
And how about when it comes to investing? How does this all play into that?
Well, if you're investing in a company that's based in another country, you have to think about not just how well that company is doing, but also how the exchange rate between your currency and theirs might change. Those currency movements can have a big impact on your returns.
Okay, so it's like an extra layer of complexity to consider when making investment decisions. But beyond those practical things, this whole deep dive into currency values has really opened my eyes to how connected the global economy is. It's like this giant web where events in one part of the world can have a ripple effect on economies and currencies everywhere else.
You're absolutely right. It really highlights how important it is to stay informed and understand these global dynamics. Even small changes in exchange rates can have a domino effect that affects us in ways we might not expect.
This has been incredibly insightful, but now I'm kind of wondering, are there any potential risks or ethical things we should be thinking about when it comes to this global currency system?
Yeah, it's kind of amazing when you think about it, how much is happening behind the scenes that we don't even realize.
Right. And it really shows how important it is to think globally when it comes to financial decisions. Something that seems like a good investment just based on how well a company's doing could be a bad idea if the currency in that country is likely to weaken.
So we've got to be aware of those currency fluctuations, but are there any bigger risks or potential problems with the global currency system as a whole?
Well, one thing that people worry about is the possibility of a currency war.
A currency war.
Yeah, basically, it's a situation where countries try to weaken their currencies on purpose to give themselves an advantage in trade.
So they're all trying to make their exports cheaper by making their money worth less.
Exactly. And it can create this kind of downward spiral where everyone keeps trying to undercut each other, which leads to instability and protectionist policies. That sounds pretty scary, like a recipe for global economic chaos.
It definitely has the potential to be disruptive. That's why international cooperation and responsible economic policies are so crucial. We need to find ways to make sure the global currency system promotes stability and fairness and doesn't become a battleground for economic warfare.
Makes sense. So, as we wrap up this deep dive, I'm feeling kind of awestruck by how complex and interconnected the global economy is, but also a little cautious about the risks involved.
I think that's a healthy perspective to have.
It's definitely been an eye-opening experience. It feels empowering to know that by understanding these things, we can make smarter decisions and navigate this complex world more effectively.
Absolutely. Understanding how currencies work is essential for being informed citizens and savvy participants in the global marketplace.
Didn't agree more. So the next time we see those exchange rates changing, we'll remember that there's a lot more going on behind the scenes than just numbers on a screen. It reflects a dynamic and intricate system that affects us all in countless ways. Thanks for joining us on this fascinating journey into the world of currency values.